Managerial accounting is all about using costs to make decisions. That's the whole point of the numbers after all. Once we know what our costs are, understand them, and know what they're comprised of, we can make good decisions. In addition to the costs we've already covered, there are a few more we want to be familiar with. We've already mentioned this cost, but it bears repeating. Relevant costs. These are the only costs we should consider when making a decision. These are the only ones that matter. Irrelevant costs don't, and should not even be presented or considered when making a decision. Differential costs are the difference between two costs. If we're looking at two options, and option A would cost $12,000 in labor, and option B would cost $18,000 in labor, the differential cost is $6,000. This is also called an incremental cost in this example because the cost is increasing. Very similar, differential revenue is the difference between two revenue amounts. This is the same as differential costs, but only with revenues instead of costs. If option A has sales of $50,000 and option B has sales of $40,000, the differential revenue is $10,000. Differential costs and revenues are relevant costs. A sunk cost is an example of an irrelevant cost. This is a cost that's already happened or has been incurred and cannot be changed regardless of the decision. Say you go to the movies. You pay $10 for your ticket. You settle in and the movie begins. About 20 minutes into the movie, you realize that it is awful and it's not going to get any better. Should you stay? You could consider many things in this decision, but one that should not be considered is the $10 ticket price. This is a sunk cost. If you stay or go, you will not get this $10 back. Instead of staying and watching the awful movie, perhaps you could go home and finish your accounting homework instead. That could be a better use of your time. If you stay at the movie, you would not be able to use that time to finish your homework. This is an opportunity cost, what you give up to choose a specific option. Once we're familiar with all the costs, we can use them in a variety of ways to make decisions. We may want to use an income statement to help make our decision. See how much profit or loss we have, examine our revenues, and see the details of our costs or expenses. This is a traditional income statement. This is just like what we are accustomed to seeing from financial accounting. We can see information related to our sales figures, our cost of goods sold, and our gross profit. We see all our remaining operating expenses and our net operating income. Another way to look at this same information is to rearrange this income statement. We can still have all the same information, but put it in a way that may help us make decisions better in some instances. We can take some of the cost classifications and arrange the income statement based on those. This is a contribution format income statement. While presenting the same information and having the same net operating income, this presents costs on the basis of fixed and variable costs. You start with your sales figure and then subtract all variable costs to arrive at contribution margin. Contribution margin tells us how much is left to pay for all the fixed costs and hopefully have some left over for profit. We deduct all fixed costs from the contribution margin and calculate net operating income. We can use this format to more easily see what impact a change in a specific type of cost behavior would have on the bottom line. This can also tell us which types of costs may need to be adjusted and show us where we may have more or less flexibility depending on whether the costs are variable or fixed. Managerial accounting can take the same information and put it into a different viewpoint to give the user a different perspective. All right, let's go out there and make some good decisions.